If you want to identify the single biggest threat to your retirement fund, um, don't look at the Federal Reserve, don't look at inflation, and definitely don't look at the CEO of the company you just bought stock in. Look in the mirror.
Yeah, it's a pretty harsh reality. I mean, we spend so much time analyzing these external financial villains that we just completely ignore the internal ones, like our own fear, greed, and, impatience.
Right. Which brings us to our mission today. Welcome to this special finale deep dive into Benjamin Graham's The Intelligent Investor. Over the past few sessions, we've unpacked his 5 core concepts, and today, well, we're putting all those pieces together.
Exactly. We are turning those isolated tools into one unified system for capital protection. But before we build this machine, we really need to inventory the parts, starting with that foundation of actual investing versus just speculating.
Yeah, I used to hear this compared to like building a house on a concrete foundation versus building it on sand. If you're chasing hype instead of demanding safety of principle, you're speculating, and the house eventually collapses.
Right. But that really just describes the outcome. I think a better way to look at it is causality. I mean, speculating is like trying to guess what the weather will be like on some random Tuesday next month.
Which requires you to basically be a psychic.
Exactly. Whereas investing is buying an umbrella factory. You don't need the daily forecast because you know this fundamental truth, right? It will eventually rain, and people will always need umbrellas.
Okay, let's unpack this umbrella factory for a second because that requires understanding what the factory is actually worth, what Graham calls intrinsic value.
Spot on.
Right.
And that brings us to the other 4 tools. You've got Mr. Market, the emotionally unstable partner whose panics are actually buying opportunities for you.
Right, the guy banging on the door offering wild prices.
Yeah, him. Then there's the margin of safety, which is buying at that 33% discount to absorb inevitable errors. Then you have defensive versus enterprising investing, proving consistency beats cleverness.
And finally, behavioral discipline, having an actual written policy. So we have these 5 distinct tools, but how do they actually lock together to protect your money?
Well, here's the core aha moment. The 5 concepts actually form a dual-layered shield against the 2 main forces that destroy wealth.
Wait, 2 forces, so we're talking about the market and ourselves. Sure.
Exactly. Force number 1 is the irrational market. So Mr. Market and the margin of safety act as your external armor against all that daily manipulation and noise.
Right, because you only bought that umbrella factory at a 33% discount to its actual value, so you have this massive structural buffer against the chaos.
Yeah, but force number 2 is you. Your fear, your greed, your impatience. Those are neutralized by that foundation of genuine investing, keeping a simple defensive strategy, and having that written behavioral policy.
Wait, I need to challenge this a bit. I understand Mr. Market conceptually, but like if I'm watching my retirement account bleed out in real time, how does a 33% discount I secured 3 years ago actually stop me from hitting the sell button today? I mean, a math equation doesn't cure a panic attack.
That is the million-dollar question right there. And the answer is that the margin of safety isn't just a financial buffer. It's actually a psychological straitjacket disguised as a math formula.
Oh, wow. A straitjacket.
Yeah. By strictly enforcing that 33% discount rule before you buy, you mechanically prevent yourself from buying into overhyped euphoric markets. You aren't trusting your willpower in the moment.
I see. So you are letting the math override the emotion. It filters out the impulse buys. Like if it doesn't meet the math, I just can't touch it. It takes my finger off the trigger before the gun is even loaded.
Precisely. And it locks in perfectly with defensive investing. By maintaining a simple, boring, highly diversified portfolio, you aren't trying to outsmart the market during a crash.
You don't need to make rapid-fire decisions because the baseline strategy requires almost no maintenance.
Right. Which leads to the final failsafe, that behavioral discipline, having a written investment policy that you drafted when you were totally calm.
So when Mr. Market is screaming at me and I'm tempted to just abandon the math, I have to literally look at a piece of paper I wrote to myself.
And that is the brilliance of the entire architecture. Graham built a system that thinks for you when you need it most.
It protects my money for myself. It's wild to think he published this blueprint back in 1949. I mean, the specific companies he used as examples are long gone, and the financial landscape is entirely digital now.
The market's evolved, sure, but human psychology is identical. The exact same cocktail of greed and fear that derailed investors back in 1949 is still liquidating portfolios today.
Yeah. And the ultimate proof that this unified system works isn't just theory. Warren Buffett read this book at age 19. He applied this exact psychological straitjacket for over 70 years to become the most successful investor in history.
He simply let the system think for him when everyone else was letting their emotions run the show.
So here is a thought to leave you with today. We've spent all this time talking about protecting your financial capital, but what if you applied this strict margin of safety and written behavioral discipline to your life outside the stock market?
Oh, that's interesting, like applying it to everyday choices.
Exactly. Think about your major life decisions or your next big career move. If we really are our own biggest risk, how much unnecessary speculation are you engaging in every single day just because you haven't written down your own rules?